we are now at the point where the next crisis will be exponentially larger than the last. The worst thing that can happen in a complex system is not a linear function of scale. It's an exponential function of scale. And all that means is that if you triple the system, you don't triple the risk. You increase it by 10, 100, some factor. It's a large multiple of the actual scale of the system. The liquidity is not going to come from the central bank because they're tapped out. Everything I said about the Fed, everyone else is worse. The People's Bank of China printed more money than the Fed. European Central Bank, Bank of England, Bank of Japan, they're all in the same boat. So they're tapped out. So what are we going to do in the 3 or 4 or 5 months when the central banks can't save us and there's no money? What they're going to do is lock down the system. They're going to say you can't have your money. So when the crisis started in 2007, even into 2008, even when it got bad with Bear Stearns in March 2008, it was looking a little bit hairy, you had really smart people. And they said something along the following lines. There were $1 trillion of subprime and Alt-A mortgages. I mean, everyone knew that the problem was in mortgages and housing values were going down. Historically, default rates, even in a bad recession, seldom got above 5%. Usually 2, 3%, 4, 5 was really extreme. So what Ben Stein and others said, okay, let's get crazy. Let's assume 20% defaults. Nobody thought it would be that bad. Let's assume 20% defaults. They did the math. They said, okay, you got $1 trillion of mortgages. Let's assume 20% defaults, which was crazy. That's $200 billion of losses. What they didn't know is that there were $6 trillion in derivatives, and you take a 20% hit on $6 trillion. Now you're talking $1.2 trillion of losses. That's enough to wipe out a lot of banks, which is exactly what happened. So it was the non-transparency, the opaqueness, the blindness of what could happen in derivatives market that caused people to be too confident about what was going on in mortgages. Well, as I said, we didn't learn any lessons after 1998. In fact, we doubled down. I mean, they repealed 1999, they repealed Glass-Steagall. That was one of the, Glass-Steagall had worked almost flawlessly for 80 years, from 1933 or 34 to 1999. You go back to the 1920s. What was going on in the 1920s? Well, commercial banks were originating garbage loans, securitizing them and selling them to their customers. So in 1929, the stock market crashed. A lot of retail lost a lot of money. We went into the Great Depression, and Congress had hearings. And they looked at this and said, oh, you guys originated garbage loans and sold them to your customers. You can't do that anymore. They passed Glass-Steagall. And Glass-Steagall said from now on, you can take deposits and make loans, and that's a commercial bank, or you can underwrite and sell securities, that's an investment bank. But you cannot do both. There's an inherent conflict of interest. You cannot do both. Well, that worked extremely well for about 65 years. Why the Congress in 1999 thought they were smarter than the Congress in 1933, I'll never know. But the point is, they repealed it. So what happened next? Banks originated garbage loans, securitized them, sold them to their customers. And it was an exact replay of the 1920s. Why should we be surprised that 10 years later you blew up the system again? It had already happened, and they fixed it, and then they unfixed it, and it happened again. What kind of learning is that? I mean, this is the problem with public policy. It's short-term. It's corrupt. It's a matter of, prevailing self-interest and special interests. No one's looking out for the taxpayer or the everyday citizen or everyday investor. Of course, when Bretton Woods failed and it was in state, everyone goes back to August 15th, 1971, which is the night that Richard Nixon said that we're temporarily suspending the conversion of dollars into gold by our foreign trading partners. They spent the weekend at Camp David, and there were about 5 people who were very close to the president who were there. So I spoke to kind of 2 of the 5 people in the room, and they, not surprisingly, they told me that they all thought this was temporary. They thought it was a timeout. There was a run on the bank, except the bank was Fort Knox. Yeah, the French, the Spanish, the Italians to some extent, the Swiss, it was just a run on the bank, except the bank was Fort Knox. The gold was flying off the shelves. In 1950, the United States had 20,000 tons of gold. By 1970, we had 9,000 tons of gold. And you said, where did that 11,000 tons go? Well, it went to our trading partners. But the pace was accelerating. We would have been out of gold, within a year or 2 at the most. And Nixon knew that. But what he thought they were doing was shutting the window temporarily, exactly like, a circuit breaker on the stock exchange. Then we would have another Bretton Woods type of meeting, which they actually did at the Smithsonian in December 1971. We would devalue the dollar against gold, which they did. They said, let's make it $42 an ounce. And then we'll reopen the window at the new value. Well, the problem is they never reopened. They did everything I said, but they never reopened the window because Countries went to floating exchange rates under the, I would say, malign and misguided influence of Milton Friedman, who thought that was a good idea. It turns out not such a good idea. To me, that's the beginning point of the modern age of complexity, and it's always been complex, but actually things are more complex. The way I would think about it is that the system's always complex. But it's more critical. Critical is a technical term. It describes the situation in complexity when you're ready to detonate an atomic bomb. You're at the critical threshold where things are going to blow up. For example, let's say I've got a 35-pound block of uranium-235, and it's shaped like a cube, and it's sitting in front of me. It's complex. I mean, it's radioactive. There's stuff going on. Neutrons are firing off and releasing, electrons, and it's creating energy. But it's radioactive, it's complex, but it's not in the critical state. So I've got my 35-pound block of uranium. It's radioactive, it's complex, it's dynamic, but it's not critical. Now, I take it and I shape one part of it, I engineer it into something about the size of a grapefruit, and I take the rest and I engineer it into something that looks kind of like a baseball bat, and I take the grapefruit and the baseball bat and I put them in a tube and I fire it together with high explosives, and boom, now I've got an explosion. I can kill 300,000 people. That's an atomic bomb. Now the point is, it's the same 35 pounds of uranium. It's the same 35 pounds of uranium. But by engineering it, you cause it to go into the critical state. So when I look at capital markets, the scale of the system, the amount of derivatives, the quadrillion dollars we talked about earlier, that's the uranium. But then the question I ask myself is, are we bending it, shaping it, or is it bending and shaping itself? Because there is this concept of self-organized criticality, which is you do it yourself, to the point where we're about to collapse. And sadly, the answer is yes. We didn't learn lessons in 1998. We got 2008. We did not learn lessons in 2008, so we're going to have another crisis. We have not done what we need to do. I mentioned banning most derivatives. That would be a good start. Breaking up the big banks. J.P. Morgan today, when I started in banking, 5 of the biggest banks in the world are today J.P. Morgan. It was the old J.P. Morgan, Chase Manhattan, Chemical Bank, Manufacturers Hanover. These are all, sound like an ancient history lesson, but these were all big banks in the 70s and early 80s, and they've all been rolled into one bank, and many, many more, by the way. Yeah, so these big banks are bigger than they were in 2008. So what did we hear about in 2008? Too big to fail, too big to fail. Well, all the banks that were too big to fail are bigger. They're more concentrated. Those 5 biggest banks have a larger percentage of the total banking assets. They're more interconnected. The derivatives books are bigger. And you say, well, so what? Who cares? I mean, isn't consolidation and merger really? Well, that will not survive the next crisis. The thing about Dodd-Frank is everyone said, and I know, Senator Dodd and Eddie Silverman, who was his chief of staff, I know people actually put this together. And they said, we have ended too big to fail because we have this resolution authority and living wills and all that. And my answer is, you haven't ended too big to fail. You have institutionalized too big to fail. You have made too big to fail a way of life because you've given yourself the false assurance that you can deal with it. And based on that false assurance, you've allowed the big banks to get bigger. You know what? There's an old saying. There are a couple different versions of it. I think the boxer Mike Tyson said it. No boxing plan survives the first punch in the face. In other words, you can make all your living wills and all your resolution plans and all that, but I promise you they will not survive a crisis, because in a crisis, people do crazy things. I mean, look, I've seen people, had nervous breakdowns, passed out, carried out on stretchers. I can't say anyone died. Well, people did die actually in Asia, but people break down. I mean, the thing about extreme stress, it can either bring out the best in you or it can bring out the worst in you. So you get frauds, you get people not answering the phones, you get people, and it's like, sorry, nobody home. That's the reality they're going to face. They're just kidding themselves. And it's an excuse to make the big banks bigger and rich. That's why Jamie Dimon's a billionaire. Everyone else is at risk.